How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I'm going to discuss with you life insurance annuity. Now, this is a little bit of a vague title, so I'm going to break this down into two separate parts. One that's going to explain a type of hybrid annuity with a death benefit rider, and then another that you could actually leverage an annuity contract, turn on income, and have that income purchase a death benefit life insurance policy, tax-free death benefit life insurance policy. So to kind of start off, let's at least talk about how a death benefit rider works and kind of different things to look out for, and to kind of weed through some of the smoke and mirrors that a lot of these insurance companies offer through the death benefit annuity contracts, which are the ones that I typically recommend to clients to help to help them understand what are some of the available options for them. Now, what does that mean? Well, with a hybrid annuity, if you've ever seen any of my other videos and you subscribe to my YouTube channel, you know that I'm a big fan of hybrid annuities. And essentially how this works is this is a type of fixed annuity that is tied to upward market movements in the stock market, with the stock market index. So what I mean by that is, let's say if you had $100,000 and you go and you place it into a hybrid annuity contract, it all has to be specific to your age. It all has to be specific to your goals, how long you want this money to grow out, etc. And what happens is your monies, it goes into one portion known as your account value side, which is your physical money, and then the other portion known as your income-based side, or variation of that word. And these are typically any hybrid annuity you're going to see on your statement. You're going to see, okay, what your actual account value did, and then what is your benefit base or income base or variation of that, what that did after exactly 1 year. So with your account value side, you understand that your money is going to grow whenever that stock market index that you choose increases at a 1 year point. Let's say that you have a 15% cap and you had an S&P index, and let's say that S&P index gained 20%. Well, you're going to be capped and you would receive 15% that year. So your $100,000 would grow to $115,000. Now that's ratcheted in there. The next year, let's say that stock market index crashes and let's say it loses 20%. Well, you have that peace of mind. You have that floor that you would have lost 0%. You wouldn't have gained anything. You would have gained exactly 0%. And now your $115,000 is preserved and protected. And then you're going on for the next year. So as your accounts value is doing that little number where it's stepping up, flatlining, stepping up, flatlining, stepping up, flatlining, you have a specific contractual guarantee through the insurance company, through the claims paying ability of the insurance company, to give you either a fixed percentage rate or something that's tied to an upward market movement on an annual basis. So a lot of the most attractive annuities might offer you like a 7% guarantee or a 4% compound interest guarantee that understands that every year your number is going to step up 7%, 7%, 7%, 7%, 7%, so that when you're looking to either exercise that income rider for income purposes, it's going to be a much higher value. It's going to be whatever this is multiplied by something known as a withdrawal rate percentage, and that's what equals your lifetime income amount. Now, with these hybrid annuities, sometimes individuals don't really care about the income side. And they're just saying, listen, I don't need to touch this money for income, but I want to make sure that my money is growing on a very safe, consistent basis, and also growing to leave as an inheritance. So this is where you could use a hybrid annuity with a death benefit rider, not an income rider. So not an income, it's going to be purely a death benefit rider. And it's going to work exactly the same type aspect. So if you had that $100,000 and you said, listen, I'm not interested in ever pulling out this money. I just want to make sure that this money is going to grow consistently. And anytime that the market beats out whatever that specific guarantee is through the insurance company, I want to make sure that these numbers both step up, that my death benefit steps up, my account value is stepping up, and everything's working very, very favorable year by year by year. So if you look at that $100,000, same thing, you're going to have an account value side that is going to have a floor of 0% and a cap up to a specific limit. So every year it's either going to receive a credit or it's not going to receive a credit. It's going to receive a credit or it's not going to receive a credit. On this secondary side, your benefit base is going to be tied specifically to your death benefit. So maybe, this might be 4%, where it would step up by 4%, 4%, 4%, 4%, 4%, or 5%, whatever that is, as a bare bones minimum. Meaning that, let's say the account value gained 3% this year, well, your death benefit stepped up 4%. So now your 100,000 is going to be 104,000. God forbid something happens to you, your beneficiaries are guaranteed $104,000. The next year, let's say that this stepped up 10%, and now your account value is sitting at 120,000, and this would have given you a 4% guarantee on your death benefit side. Because your account value is now higher than your death benefit, this is going to step up, meet it, and now you have 120,000 there. The next year, let's say that the account value, that the market crashes, you gain 0% on your account value side, but this is now stepping up 4%. So what's happening is this benefit base keeps accumulating to a certain point where, let's say, God forbid you pass away, your beneficiaries are not just going to receive this side, but they will be able to receive your death benefit-based side. So it's just a way on how you could leverage your money to make sure that you're not just throwing it in a cash account and you're not receiving any interest on it. You're leveraging an insurance company to give you some sort of contractual guarantee to make sure that you could leverage your dollars the best way possible and provide your beneficiaries with the highest benefit possible. So it's very, very important. On how exactly those different things work. Now, one of the things I mentioned at the beginning of this video is I said I want you to weed out some of the smoke and mirrors. What do I mean by that? Well, you have some contracts which you might have a very favorable death benefit growth, a benefit-based growth of 7% or 10% year by year by year by year, but some of the caveat to it is after you have this large lump sum, you're going to have your account value, let's say, in that scenario of $100,000, let's say after 10 years, your account value is sitting at $200,000, and your death benefit, your benefit base is sitting at $300,000. Well, some carriers, they say, okay, yes, your beneficiaries will be able to receive this $300,000 number, but the caveat, the smoke and mirrors, is they have to receive it in 5 consecutive years, meaning that instead of having it as $300,000 lump sum, it would have to be $60,000 every single year for 5 years, because obviously 60,000 multiplied by 5 years equals the $300,000 number. So they would have that option to either pull out this as a pure lump sum of the account value side, or pull out this benefit base death benefit as a 5-year increment. Now, understand, this benefit base, this does not mean when you're looking purely as income riders, typically companies, they either are going to give you a death benefit rider or they're going to give you an income benefit rider. Typically, they don't offer both of those. And if they do offer both of those, the fees are going to be astronomical, where I would recommend against doing that. So understand, is the product that the specific company is offering you, are they going to be able to pay you this death benefit, this benefit base, in a lump sum option, which some companies do offer that, which I highly recommend? Or is it going to be some smoke and mirrors where they're going to pay you out in a 5-year increment where it's not going to be as favorable as you would think? So, it's all about how exactly you leverage the best products out there. And understand, you have over 1,200 different scenarios, over 300 different product lines to choose from based upon your age, based upon your specific dollar amount that you're placing in there, based upon your specific goal. I mean, there's so many different ways to skin that cat. And rather than just going into it blindly, you have to understand and you have to be educated every step of the way and understand exactly what is going to be the best solution. That's why one of the things that I always mention during every video is give our 1-800 number a call. What we do is you might be speaking with myself, you might be speaking with some of my other representatives, but what we do is we help you understand what your goals are. We ask you certain questions to get your brain thinking on what exactly is it that you truly want with your money. What do you want your money to do for you, and how to do that on a very safe basis, and how you could leverage certain types of annuity contracts. Maybe it's meant specifically for income purposes, for lifetime income purposes. Maybe it's meant specifically for death benefit purposes. But what time and time again people call our office because they're terrified that the market's going to have another 2008 market crash, and they do not want their money to crash and not be able to leave anything to their loved ones. So that's the first aspect. Remember how I told you we have either the hybrid annuity with the death benefit rider, or you could take either a hybrid annuity or a single premium immediate annuity, pull out income from that, and purchase a a death benefit only policy through life insurance. And this is a really, really neat way on how to do this. And I do this a lot with people that come into certain types of pension scenarios. So you could do this through either annuity product lines. You could do this through people that have like TSP plans that they're taking the single life only pension option as opposed to the joint life pension option. So actually, let me pull up a new screen and show you. I'll show it to you on the pension option that I have clients that call in, and then I'll show it to you on the annuity option. Let's say somebody has a TSP plan or they just have some sort of pension plan and they are through work and they have that option to either choose a single life only option, or they could pull out they could take the joint life only option. Now, let's say if they choose the single life only option, this person's age 60 and their spouse is, let's say, age 60. If they choose the single life only option, let's say the company's going to pay them $50,000 a year. But if they take the joint life option, then the company's only going to pay them $30,000 a year. What I explained to them, and this only works if the person is insurable. So this entire strategy only works if this person is insurable. If this person has some crazy ailment such as cancer, some sort of terminal illness, this will never work, and I highly recommend against doing this. But it works perfectly for the correct person. You could essentially say, rather than give up that $20,000 of income to say that both you and your spouse are going to be covered, what you could do is have that first individual take out the single life only option for $50,000. Let's say they're getting paid $50,000, and they could essentially purchase a $10,000 a year. In that scenario, I mean, there's whole different ways you could skin that cat. You could take the $50,000 option, purchase a $10,000 life insurance policy for $500,000, making sure that something happens to that single life individual, the income doesn't stop, because now the spouse will receive a lump sum of $500,000 of tax-free death benefit that now they could live off of for income and either place that into an annuity contract later on. So what's happening there is when you do this aspect of taking the single life only option, you're netting $10,000 more than taking the joint life option, making sure that both spouses are covered. With this option, when you take the $50,000 and you take $10,000 out to purchase the life insurance, the spouse is going to be covered tenfold, and you're still netting pure profit of $10,000 extra dollars year by year by year. Where did I get this $10,000 extra? Well, with the joint life option, you would have been $30,000, or with a single life option, you would have been $50,000. That's a net of $20,000. Now, out of that net of $20,000, you're taking $10,000 purchasing the life insurance to receive the to make sure that you have a $500,000 death benefit there. So in this scenario, let's say that the first spouse B, the one that doesn't have the single life option on their life, let's say they pass away first. Well, now they're making out like a bandit, and they could cancel their life insurance if they want to and just increase their net profit to $20,000. Or if that individual A, the person that has the pension option is let's say they pass away, well, now $500,000 of tax-free money gets paid out to their beneficiaries. And this couple was netting $10,000 year by year by year by year by not taking that joint life option. But like I mentioned before, it only works if you have the specific situation, if you are insurable. If you're not insurable, then it's not going to work for you. Now, one of the other things that I mentioned was you could also leverage an annuity contract. Some people say, hey, listen, I want to have, I want $100,000 and I want to throw it into a death benefit annuity. And I always say, well, listen, are you insurable? Because if you're insurable, we could essentially take this money, place it into a hybrid annuity, meaning that your $100,000 you would receive, you have your account value of $100,000, you have your income base that would start off. You have some companies that would pay you an income base of, let's say, $7,000 from the first 30 days. Well, you could use this $100,000 that you just want to be left to your beneficiaries, take $100,000, place into a hybrid annuity contract, have that hybrid annuity get turned on instantly with lifetime income. Understand that you're still going to have account value growth there, where your account value is going to gain, flatline, gain, flatline, gain, flatline. you have a set income stream on your life only for $7,000 year by year by year. You take the $7,000 and let's say you purchase a life insurance policy for 300 grand. And that's how much it's going to cost you for a $300,000 life insurance plan. So now, let's say you pass away after a couple of years. God forbid you pass away after a couple of years. Your beneficiaries would receive what's ever remaining in your account value side, and they would receive $300,000 of tax-free death benefit. So the point that I'm trying to make is understand if you have a specific goal for a maximum death benefit and you are insurable, you could take your money that you were just looking about leaving in a cash account anyways, and you can multiply that up to 3 times and also have that money go to your beneficiaries in a tax-free manner as opposed to something that could potentially be taxable. So there's so many different ways to to really skin this cat, and you just have to understand that you do hold the power. You have the power of leverage. That you should never go into one-size-fits-all strategy. Each individual is different, meaning that if you're at a seminar and someone's talking at a seminar, and let's say there's 20 people or 50 people at a seminar, the odds that all of those individuals are going to have the same goals, the same strategies, is going to be impossible. It's absolutely impossible. Not everybody's the same age. Not everybody has the same life where they have to have, each one has to be tweaked specifically to their situation. And, that's one of the things that we're very passionate about. And, that's kind of why you hear the excitement in my voice, is because this is something that we deal with on a daily basis. We have many satisfied clients. We are A+ rated on the Better Business Bureau. And we've never had complaints. We've always had good reviews. And the reason being is because the way that we educate, the way that we try to help you understand that you do hold the chips. You don't have to just go into this with a big question mark and not understand that you do have options there. So, once again, one of the things I mention in every video is please give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service. We will educate you till we're blue in the face, and you'll be able to, whether you're dealing with myself or some of my other representatives, you're going to be able to see that we'll definitely show you some neat little strategies. There's over 1,200 different scenarios, different strategies that we go per individual that calls in. And, we have different software, we have different case design teams that really help us out. And, at the end of the day, all we're trying to do is really solely trying to give you as much benefit as possible. Once again, my name is Derek Afasi. I want to thank you very much for watching this video. Please make sure to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. And I want to thank you once again for watching. Take care.